Today, we will talk about illiquid assets, an overview, the risks they pose, and real-world examples of illiquidity. Illiquid refers to the state of a stock, bond, or other assets that cannot easily and readily be sold or exchanged for cash without a substantial loss in value. Illiquid assets may be hard to sell quickly because there is low trading activity or interest in the issue, indicated by a lack of ready and willing investors or speculators to purchase or sell the asset. As a result, illiquid assets tend to have lower trading volume, wider bid-ask spreads, and greater price volatility. Regarding illiquid assets, the lack of ready buyers also leads to larger discrepancies between the asking price, set by the seller, and the bid price, submitted by the buyer. This difference leads to much larger bid-ask spreads than would be found in an orderly market with daily trading activity. The lack of depth of the market, or ready buyers, can cause holders of illiquid assets to experience losses, especially when the investor is looking to sell quickly. Illiquidity in the context of a business refers to a company that does not have the cash flows necessary to make its required debt payments, although it does not mean the company is without assets. Some examples of inherently illiquid assets include houses and other real estate, cars, antiques, private company interests, and some types of debt instruments. Certain collectibles and art pieces are often illiquid assets as well. Stocks that trade on over-the-counter markets are also often less liquid than those listed on robust exchanges. On the other end of the spectrum, most listed securities traded at major exchanges, such as stocks, ETFs, mutual funds, bonds, and listed commodities, are very liquid and can be sold almost instantaneously during regular market hours at fair market price. Illiquid securities carry higher risks than liquid ones, known as liquidity risk, which becomes especially true during times of market turmoil when the ratio of buyers to sellers is thrown out of balance. During these times, holders of illiquid securities may find themselves unable to unload them at all, or unable to do so without losing money. Illiquid securities also may demand a liquidity premium added to their price to compensate for the fact that they may be difficult to dispose of later on. Illiquidity can leave both companies and individuals unable to generate enough cash to pay their debts. For example, The Economic Times reported that Jet Airways had delayed repayment of overseas debt for the fourth time in recent months due to a corporate illiquidity crisis that left the company struggling to access liquid funds. As a result, Jet Airways not only had to ground more than 80 planes, but it also put together a resolution plan that called for the resignation of its chair, Naresh Goyal, and the board voting to allow lenders to take control of the airline. Here are 3 key takeaways. 1. Illiquidity occurs when a security or other asset that cannot easily and quickly be sold or exchanged for cash without a substantial loss in value. 2. Illiquid assets may be hard to sell quickly because of a lack of ready and willing investors or speculators to purchase the asset, whereas actively traded securities will tend to be more liquid. 3. Illiquid assets tend to have wider bid-ask spreads, greater volatility and, as a result, higher risk for investors. Hope this would help. Thanks for watching.